Welcome to the Dealmakers Coffee Break. I'm Asaf Raz. Let's go. So welcome to another episode of the Dealmakers Coffee Break edition. And today I have a returning guest from season 1, Chad Sutton, which I talked to his mom lately, Tammy, but don't tell anyone. He's from Quattro Capital, which is one of my favorite companies because of the value they bring into the world of real estate investing. And Chad, if anyone doesn't remember, please take it away. Tell us a bit about yourself and Quattro, and we'll take the conversation from there.
Yeah, absolutely. Thanks for having me back on the show. You know, we think a lot of you guys and the products you guys have out there as well. And, big secret, we are finally launching our, as of this recording, Agora platform this week. 30th is the day.
Congratulations, man. Congratulations.
Yes, I'm so excited. Anyway, who am I? My title's Director of Acquisitions, but my scope is really director of anything transaction-based in Quattro Capital. So I run everything related to capital markets with the debt side, everything related to deal structure, underwriting teams, refinance and disposition opportunities, and everything that touches, right? So I'm really more on the transaction side of Quattro. And, a little about me on the nerdy side. I am a recovering engineer, folks. I was in corporate America for a long time, climbed that ladder, didn't like what I found at the top, and decided to build my own ladder. But, I did some cool things. I was a combustion engineer for a long time. I got to be one of the people who recovered the aftermath of the GE stock price implosion, if you remember that back in the day. Mm-hmm. So, had some very fortunate experiences being right place, right time, and made me who I am today.
Since our last conversation, a lot of things changed in the market. What are we actually seeing on the ground? What are you feeling on the ground today that has changed comparing to last year? And what are some things that Quattro is doing today to kind of fit your business model into the current state of the market?
Yeah, thank you for that question. And folks, the first thing I'll say is if you're an operator today, you have felt some headwinds. The winds of disaster, the winds of change, and the winds of opportunity, they blow on us all. So let them fill your sails and ride the freaking wave. And quit, no woe is me activity, right? But the first thing I'll say is everyone operating or investing today, you should consider yourself very fortunate because you are getting to live cycles that usually take years to manifest themselves that are happening in quarters, right? I know mentors of mine they have gray beards and lots of scars and stripes who have been in this industry for over 50 years. And they haven't seen this. This what we're living today has not happened in America since the 1970s and early 80s. Okay,
explain it for those who don't know what's happening right now that hasn't happened for so long.
Yeah, so and folks, if you haven't watched the economic cycle video by Ray Dalio, go spend 30 minutes of your life and watch it. It's on YouTube. It'll really just help you understand the economic cycle, but. What we are living is what's called a big debt cycle. And we know everything because I won't go into this rabbit hole unless you want me to, but because we have fiat currency around the world, it's static, or it's not static. Money gets worth more and less depending what's going on. Well, again, we know we've been living inflation in our country and around the world because we pumped a lot of money during COVID to prevent the world from revolting during the COVID shutdown, right? Well, I mean, I'm not arguing it wasn't necessary, but it has implications. We doubled the money supply. And so we've been feeling the effects of inflation massively. The last time we had massive inflation was late 1970s. And what did they do? They ran rates up to 18%. Some of your parents will remember buying homes at 18%,
wow.
At the time. I don't think we're going to go that high, but that's what we're fighting is an increase in money supply and the inflationary effects as that are a result of it. The other thing we're fighting is there is a lot of attacks on the U.S. dollar as being the world reserve currency. And I'm not here to debate that politically, whether it's right or wrong, but, like it or not, other countries around the world have not felt we've been super judicial or judicious with our power as the world reserve currency. And so there's challenges there. So the Fed has two jobs. One is to protect the U.S. dollar. We think number one is inflation. It's not. Number one is protect the U.S. dollar as the world reserve currency. And you think it's a coincidence that banks like SVB and crypto.com or whatever it was, and I think the other the major FTX that recently went under investigation went down. You think that's a coincidence? No, that is the Fed protecting the dollar. SVB was very heavy in crypto. They allowed it to fail. They could have backed it up. They allowed it to fail. And FTX was a major crypto contender who had a lot of support and was threatening the world SWIFT system, how we move money around. The Fed will turn off the freaking power if they have to protect the money supply. So I digress there, but that's their number one job. Number two is price stability. We cannot have hyperinflation in this country, or the ripple effects of that with us being the world reserve currency, or we will no longer have the power we do over oil and all those massive commodities that are traded in US dollars. So that's what we're dealing with. And so if you bring it all the way back here to the micro scale, if you are a property operator today and you're dealing with this debt cycle that is a byproduct of the interest rates being hiked very rapidly, which isn't good for us property owners who probably had some business plans we're trying to operate, you're going to have to ride the wave because the Fed doesn't care about you. They care about those two things we just talked about.
Mm-hmm. That's a great, I've never heard this one before. So you're talking about the macro environment, right? What's happening as an operator? What's happening on the day-to-day? How does that influence specifically you or Quattro in terms of your strategy?
Yeah.
Like your investments, how you do lending, like what are those influences?
So let's bring it all back down to the macro property level environment. We were just talking macro globally, global economics, which if you're not a student of it, you better become it or it will crush you, right? But macro real estate economics, inflation has not been lost on us. We have felt construction prices go up. Pretty much every tech thing, our tech stack has gotten more expensive. People have gotten more expensive. So payroll's up 40%. Insurance, let's not even talk about the insurance world that is in turmoil because of the amount of claims and natural disasters we've had in the last several years. So whereas we used to be really accustomed to $250 to $300 per unit in insurance, that don't exist anymore. At best, you're looking $400 or $500 a door. And if you're in coastal markets, you might be looking at $3,000 a door. It's massive what the number is. So we're in a world where expenses are rising faster than we can get income up. And that's a scary world to be in, folks. And so being efficient with how you're spending your OPEX dollars is very, very important because I don't care who you are, your OPEX is up. Now, the good thing about multifamily real estate, I can't speak for other sectors as intelligently, but the good thing about multifamily real estate is as long as the market fundamentals in your market, people are still moving in, jobs are coming in and wages are going up, eventually, it'll take you 3, 4, 5 years, but eventually we will restabilize that income line because we're not going to sit there and just not raise rents. We're going to push as hard as we can to maintain that OPEX ratio. Everything is rebalancing. Expenses are hitting first. Now let's talk about the income line a little bit though. The income line, what we're seeing is, we are in a recession, whether anyone will admit it or not. Okay.
Yes.
We are seeing that behavior. Occupancy has dropped. Across the nation, it's gone down an average of 300 basis points, about 3%. Some markets are as little as 1%. Some markets are as high as 7, 8, 9, 10%. It's a local issue, but in most of our markets, it's 3 to 5%. We've seen occupancies drop. We're having to fight more to get those residents. Not everything you put out there for lease just gets snapped up at whatever price anymore. So what's happening? That has induced rent growth to moderate, not because we can't get the leases, because we can't get the leases fast enough, right? So envision you're a property owner and you have 10 leases and now you realize, well, gee, they're not all going to get snapped up real quickly. Well, the longer they sit, the more it costs you. So you're probably going to say, well, instead of $100 rent bump, maybe I'll be happy with a 50 because if it sits for 30 days, I've lost a whole year of benefit, So you are seeing rent growth moderate, not because the population isn't there, because we felt some element of people moving in together and households reducing a little bit, right? The supply and demand problem is still there, folks. We're still 3 million homes short, and we're still 1 million rental units short and closing. So that hasn't gone away. But we also have massive deliveries coming this year. Why? Because, and when I say deliveries, I mean new construction. In 2020, remember that little thing called a pandemic we experienced? We're still feeling economic long COVID, right? We're still feeling the impacts of that. A lot of money said, I still want to be in this sector, but I'm not going to go operate right now because I don't know what lenders are doing and I don't know if people are going to pay rent. I'm just going to go build something. And 3 years from now, it'll be ready to go to market. Well, guess what? It's 3 years from now, right? So all that stuff is coming to market. We have a massive amount of new product hitting the market, not enough to close the gap on rental units needed. It's making a dent, but after this year, it tapers off. So you're feeling two effects there of, occupancy coming down a little bit and rental growth moderating. So if you're thinking you're going to go get 10 to 15% organic rent growth without doing much work as you have in the past, you're probably not going to see that for the next year or two, and then we're probably going to get back to the normal rate of 4 to 6%, which is a little elevated from gross average over a long time. Mm-hmm. So you can still renovate units and snap things to market. That still works, but you're seeing longer downtimes. You're seeing a little more delay in getting it back up. So you're feeling a little more economic vacancy, which means net effect, the income line is not moving up as fast as it used to, and the expense line is moving up a lot faster than it used to. So you really have to be operating well these days.
Do you feel like people usually underwrite or take into consideration in financial modeling this kind of behavior within their real estate assets, specifically talking about multifamily? Like, do you feel like anybody knew to calculate that in?
No. And I think, especially if you're buying, you're still seeing brokerages putting out the same 2% expense increase. Mm-hmm. They might, if they're smart, be snapping things to market on expenses, which means your in-place cap rate really doesn't mean anything anymore. You have to be looking at tax and insurance adjusted cap rates day one. What is your takeover cap rate? Because right now, those numbers used to be pretty close together, like the in-place cap rate on T3, T12, T6 versus the takeover. Now, the last deal we looked at, which we're considering buying, is, it's a 5.8 cap rate on in-place, which is fantastic. That same deal would have been 4 just last year, But by the time I'm done adjusting expenses to where they really will be for us, it's a 5 cap. So you have almost 100 basis points of spread between like what the actual cap rate on the T12 is and what you're going to see as the operator. So that's a big thing. And back to the underwriting side of things, you really shouldn't be banking on much, if any, organic rent growth over the next year or two. You might get some, but you need to be prepared for none and make sure that underwrites well. You're probably still going to be able to get your rent bumps for renovation, which is because that's taking something old and making it new, and that will cost more still. But you really have to assume that organic rent growth is a lot lower, and it takes a lot longer to get things leased up and hitting the books, right? So that really kills a lot of deals, because the second part of that, you have to think about, okay, my expenses are up higher, my income is moving slower, and we're just not really sure where our long-term interest rates are going to be, which, we can argue interest rates don't drive cap rates all day long. They really don't, but interest rates do drive money flow, and money flow drives cap rates. If money is not going into multifamily or commercial real estate, cap rates will go up. If it is going in, cap rates will go down. You want to bet debt doesn't influence that. So we're not really settled yet on, where should a cap rate be today? And I've never had a harder time valuing property than I do right now. And that's both on the buy and the sell side, because it's like, well, what is reasonable? What does market need to see? And how conventional wisdom suggests we're at the peak of the rate cycle. We might climb a little higher, maybe 50 bips higher, but it's really hard to get people in a rising rate environment to buy something with negative leverage. That is, the cap rate is lower than the interest rate.
Yeah. On the flip side of it, I know that a lot of GP syndicators chose to not take fixed rate loans throughout their multifamily investment cycle, which means that payday has, I think it started at the beginning of the year, but payday for bridge loans it's here. And they're not used to being able to, they're used to being able to come back every year and say, hey, dear lender, whatever lender that is, I need better terms than what I had last year. And they would be like, okay, you get better terms because money's cheap. What do you think? Have you seen any entrepreneurs encounter this situation? And if so, how do they deal with it? I feel like you have to sell, right? Or you have to call capital, how do you see them deal with that?
Yeah, that's a great question. And we may spend the rest of the time on this one, but we're in a big debt cycle, as I mentioned. And, a big debt cycle can have a catastrophic ending or a soft landing. It could have what's called a smooth deleveraging or a catastrophic deleveraging, go watch Ray Dalio's video. But yeah, here's the situation, right? And, fortunately, we have been students of the economy long enough to know okay, we don't need to be leveraging high right now. We know rates are going to go up at some point. Now, we thought conservative was like all-in rates would be 4.5%, 5%. We're way beyond that, right? So we did not have the wherewithal or knowledge to know this was coming. I don't even think anybody did. But the challenge is, in the last 2 or 3 years, if you've been putting bridge debt on your properties, that's okay, as long as you were mitigating the risk, right? One of them is through interest rate caps on variable loans. So we were buying 1 and 1.5% strike rate caps before it was cool. People thought we were crazy and wasting money on it. Well, who's laughing now, right? SOFR's at like 4%, and we're dealing with 1. So that kicks the can down the road because we have kind of an insurance policy against the rate. You've seen a couple of properties going back to the bank already where they were bought highly leveraged and to the tune of like 75 or 80% bridge. Then they put pref equity behind it, and to get to 85, 90% leverage. And, so anything above 75% leverage, you're probably hurting right now, because bridge loans are typically 2 to 3 years, and they'll give you 1 or 2 years extensions, but those extensions aren't guaranteed. You got to hit debt yield. You got to hit all sorts of other covenants they might.
And insurance rates that went up.
And insurance rates. So your OPEX is also up. So your NOI is probably, you've probably gone slower than you thought you would, because we've had supply chain issues. Your expenses are higher. So your NOIs may not, even if you're getting rent bumps you thought you would, your NOIs might not be where you're supposed to be. So let's talk about the solution.
Mm-hmm.
So we have, you really have 3 levers to pull, and they all equal money, right? So if you bought it low enough, or you were leveraged low enough, we've already refinanced a couple things to mid or perm debt, which has been great. If you have that ability, you're probably like, okay, well, this sucks, but I'm refinancing it, 5.5 to 6.5%, but I'm able to refinance. And if you do that, okay, fine, get yourself a 4 or 5 year loan. Don't go 7 or 10, because you're going to be kicking yourselves 8 years from now when that prepayment penalty's through the roof and you locked in at 6. But give yourself, 4 or 5 years to get through this, interest only as much as you can. Mm-hmm. I'm recommending the 5-year Fannie product or Freddie product, because if it underwrites well, you can get full term IO. It's assumable. You can put a supplemental loan on it. So it really gives you maximum flexibility in that the loan is assumable if you decide to sell 3 years from now instead of terminate. You're full term interest only, which makes it more attractive to buyers and to you. And you're only locked in for 5 years. So when the rates do come back down, and I say when, they will. Question is when, when they come back down, you're not locked into a 10-year loan. Like, you can probably go refi at 4 or 5% wherever we're going to be. So that's option 1. Option 2 is you really need to look at bringing in extra equity, right? And so look, equity is expensive because it's in for the life of the loan. It dilutes everybody else that's there, assuming you come in common equity. Or you could look at pref equity, which kind of comes in front of your current investors, or you, if you're the equity. And that's not really that palatable, but it may be what you have to do, because if your property has $4 million, and let's just say $4 million in debt on it, and it only underwrites for $3 million today, you got to come up with that extra $1 million to get that loan out or hand over the keys, right? The second part you can do there is, there are a lot of debt funds, us included, debt funds out there who will say, okay, hey, we'll lend you 8 to 12% money, and just give us at least a year of interest and then get us out. So if you just need a time to get from now until 3 years from now or 2 years from now, we'll lend you the money. We're going to be in front of all your equity and require a personal guarantee, as most will, but it gives you time to let the rates moderate, and then you refinance, into a long-term loan. So there's ways to do that. Now, option number 3 is you sell. And this is where we've seen prices moderate. They've not moderated near to the point, as Green Street will tell you, they've not moderated near to the point they need to be to make the expense loads and rates make sense today. Yeah. What's going to cause that is distressed and motivated selling. And so we've been able to hold on, everyone has, hoping for a sunnier day. But as these loan maturations really start to stack up, this is where the true choice of, well, can I refinance? Do I have the equity to make up the gap if I can't refinance? And if not, I got to sell. And then you're going to basically sell when you have to sell, and that's going to be where the market will bear. And so, the only way you get in trouble in this market is you run out of time or you run out of money. I say this all the time. And I don't know why I just made an L with my hand there. Time or money. And time, like when a loan is coming due, that can force you to sell at a time when it's not the best time to sell, which is going to be where deals come from. So that's kind of the trifecta of what your options are. I would say, well, and secret option number 4, most lenders learned a big lesson in the Great Recession. They don't want to see massive defaults and keys coming back on their balance sheet. Most don't. There are some lend-to-own players out there, so be careful with those. But talk with your lender early. If an extension needs to happen or a restructuring of the loan needs to happen to extend it a couple of years, talk with them. Some will say no, pound sand, but sometimes especially if it's a bank, they'll probably be more apt to do that because they don't want to see a bad loan on their books. If you're paying and you're a good client, you can probably just kick the can down the road a few years, maybe for some penalties or whatever you can negotiate. And, that may be what a lot of people are already doing that, I guess is my point. So those are kind of your 4 options. And I think that kind of covers it, but look, this isn't a woe is me time, folks. Don't put it off. Get ahead of it. Any refinance we have coming this year, we've been working on for 6 months, so get ahead of it, plan right. If you got to change operations, do it. And just, make sure you're managing your debt portfolio just like you're managing your asset portfolio.
I love that, Chad. I love that. I always leave space in the episode for what I call a shameless plug, where you shamelessly offer people what you're selling, what you're doing today, how you can help them. And just feel free to do that without, as I said, no shame. Just go ahead.
Yeah, I guess 2 shameless plugs. One, we have a great podcast that we're talking about stuff like this all the time. Real Estate Runway, Anywhere podcast or YouTube videos or anything like that are shown. I think we're even on TikTok now for your swiping pleasures. So check that out. Real Estate Runway podcast. And the other is,
link is going to be in the bio. The link to the podcast is going to be in the bio. We'll make sure.
Perfect. And the other is, we are an active investment firm. We have, fixed income funds, common equity funds, launching a pref equity fund to kind of go rescue some deals about being in trouble. So, we are private offerings. We'd love to get to know you, but if that sounds of interest, reach out to us at thequattroway.com and we'd love to have a conversation.
Chad, as again, one more time, it was a pleasure having you on the podcast. It's always a pleasure having you on the podcast. And we'll see you all in the next episode. Thank you so much, Chad.
You're the man. Thanks.
Thank you for joining us. Check out more episodes on the Dealmakers podcast, available on Spotify, Apple Music, Google Podcasts, and Agora's website at agorareal.com/podcast. See you in the next episode.